What's up traders? Tom here with another video. Today we'll be discussing 3 early warning signs that the global economy is in for a shock, and our thoughts on Tudor Jones's recent statement about the second wave and the implications to the global economy. Stay tuned. I would just like to thank everybody for their continued support in the trading community of this channel. And of course, if you enjoy our content, remember to subscribe and hit the alert bell down below to receive daily content on YouTube. So let's begin by talking about the second wave. And that is the second wave of potential infections that several countries are already starting to see. With the US economy about to open up along with many other global economies, this is something that I think the stock market has not considered and will be a very important lead indicator for every investor to look at when considering bullish positions or bearish positions over the next few months. So here we have South Korea, and South Korea has already had a second cluster outbreak linked to a nightclub, which I'm sure many people are aware of. The importance when looking at these kind of things is to think about what they have to do. So firstly, they will have to obviously close off potentially anything related to that nightclub to stop the infections. So in South Korea, before they got it under control, it started spiking relatively heavily, relatively quickly, just like anywhere else in the world. Right now, we might be at a small amount of cases, but if we start to see an increase like this, the governments will probably jump in and then they will look to lock down these economies again, causing another financial shock. If they choose to leave it open, obviously we're going back to having more cases. And I don't think they're prepared to do that just yet in terms of the economic impacts versus the health impacts. But what about in Germany? So in Germany, the Robert Koch Institute, or Koch, I'm not sure how to say that one exactly, shows that the daily estimate of reproduction in Germany was rising in early May. And this is another key statistic we want to look at. So the rate of infection of greater than 1, as many people are aware, is the important factor. And it looks like Germany has raised and moved above 1 at this stage in terms of contagion from person to person. If this trend continues, we will need to watch out for that, because again, I don't think the stock markets have priced this particular position in. That leads me to the last one, and probably the economy that has been open for the longest in terms of closure then reopening, and that is China. So China has recently, over the weekend, shut down an entire city near North Korea's border as cases have begun to spike. Now, the importance of this is that China has a very hard-hitting stance on when they see cases. They're often claiming that they're, of course, imported cases, and they are closing down and shutting down the entire city automatically and instantly. The problem with looking at China's data is we're not 100% sure what's happening. So in a recent video, which I'll tag above, I talked about how you might be able to look at the idea of whether China's really open or not based on satellite imagery of actually pollution over industrial areas. This is definitely a lead indicator, and I think it's important for everyone that's trading the S&P 500 or any other index in the world to consider. The second thing I want to talk about is lead indicators from the perspective of actual commodities that are traded. So oil is a great lead indicator because it's difficult in some ways for it to be manipulated currently, as long as, of course, we do still see record outputs and not much demand. So the thing about oil is it started selling off before the middle of January, actually, and then it started moving down until it broke key support of around $50. Now, if we look at the dates coming into the March crash over here, actually it had already broken through the key support. So it was leading the rest of the market with the key break of support and then continued to move down, finding incredible weakness recently, of course, while the economies were shut for a period of time and the glut of supply came into the market. So oil will be one that we will be looking at as a lead indicator to show us potential movement either way in the stock markets. The other one, and often underutilized by many retail traders, is copper. So you'll want to look at copper and you'll want to look at key support resistance areas and again look at dates. So around the 13th to 14th of January, there's no coincidence that copper started falling. Now, copper's usually a heavily used commodity in terms of infrastructure, and that's why it often suffers during economic collapses, and it does really well coming out of economic recessions. So copper is one that we'll watch, and it's coming back to a key level of what we call role reversal. So in terms of where copper could go to, it could potentially go to 2.5. And then these 0.5s have always been strong resistance and support. So we had support over here, and that support could become resistance, and then all the way back down to 2 could be what we expect. And this is the important thing. Copper will lead the way. Again, we saw it moving off the China news, and we saw it moving before even the rest of the world. And then it started moving with the stock market heavily selling off. And that was actually even more of a lead than the S&P and other indices. So the next point that I want to bring up is opening up the economies again. And in terms of the lead indicator to see whether people and consumer spending is coming back. Now, we obviously know that we will get reports on this, but as an investor, I always like to think about the things that are happening around us because sometimes they can help us in terms of making logical, educated decisions. So this chart was actually made on April the 10th and 16th, and basically it showed a percentage of Generation Z and millennials that were prepared to do certain tasks. And I think this stands for a lot of the population. Obviously, the older the person, the less likely they are to do certain things like this. But it does show a general consensus of certain events and surprisingly, even events that I would consider this generation wouldn't necessarily be so scared of, starting to consider what we call long after the vaccine is out and the percentages that they would not go and do something. So if you have Generation Z and millennials, literally when the economies are back open, not going to restaurants as much, not going to movie theaters as much, and more importantly, of course, the sporting events, large events, everything like this, which are probably going to be shut down anyway, they're at a very high percentage that will not go before the vaccine is at least out and long after it's out. Now, this does real damage to many sectors of the economy, but I think it shows that people will remain scared, and we have seen a fundamental change in the way that people will approach life. And this is important when you're thinking about the sectors that you want to invest in the stock market. If you're investing in certain sectors and those sectors are going to be heavily impacted by this thought process, I'm sure that it will eventually come back. But at the same time, it's important to note that if you're outside and you are just seeing new businesses open and those businesses are clearly not doing well still and things are not going back to normal and you're seeing the stock market at all-time highs, that doesn't necessarily work out. And we are in unprecedented times with stimulus, of course, being printed out of control. But at the same time, you have the counteracting. What you see around you does have an impact on the economy. And if everyone's doing it and you're seeing a current event happening time and time again, it's a forward indicator for what the figures are going to show, and it will help you in making your investment decisions. I've done this before and it has helped me in other areas. When I'm looking at certain sectors, I've literally just gone out on the streets and thought about those sectors and seen and spoken to the businesses, and you can get a bit of an idea of how things are going. So very interesting there. So I think we're going to see in the figures that there's going to be a spike in spending, specifically in countries where the governments have given out stimulus checks. That's called like the sugar rush. And effectively this sugar rush is going to be spent in the economy. And I think it actually is going to prop the economy for at least a couple of weeks in terms of spending. Brings me to my second image here. And this is actually an image taken in Australia recently of people in a shopping centre during what we would call stage 2 lockdown. So this brings me to my final point, and I'm going to circle this point because basically this is the problem that we're facing. It's human nature to want to interact with other humans, and we've now been in lockdown in most countries for months. Now, if we've been in lockdown for months, what is going to happen when the governments say it's okay? Well, here in Australia, the governments didn't even say it's okay. And this is a picture taken recently at the shopping centre showing the amount of people in close proximity. This is clearly a problem if we are experiencing a second wave. And it shows that people will not be in isolation for much longer, regardless of what people say. It's interesting that today, Tudor Jones has come out and said that this will be a second depression if we remain in lockdown a year from now. Now, I don't think it's surprising that, of course, he believes that we'd be in a depression if we were in lockdown from a year from now. I think everyone would totally agree with that. But it does show the fact that if we continue to see outbreaks and shutting the economy and outbreaks and shutting the economy, it's going to be hard even for the Fed to hold the market where it is. So some people may call me a bear, but realistically, I'm actually bullish on everything in the stock market. And the main thing I believe in is you always want to have good risk management. And that risk management may mean that you potentially have a cashed up position in some portions of your investments. Doesn't mean that you ever remove it all though, because of course, being a perpetual bull pays off with people like Warren Buffett and other people making huge amounts of money over the longer term. So it is interesting that we've had a massive move on the S&P 500 and we're at a key zone for the market technically at the same time that we are seeing the opening of the economy. And I think it's absolutely no coincidence that the S&P 500 and other indices are at key zones right ahead of reopening. They've also been relatively stable at these zones compared to what we've seen recently at this time. And this is because the Wall Street is waiting to see whether there will be a second outbreak. And I believe that that will be the catalyst for a sell-off if there was one to occur. So I'll leave you with this question today. Do you believe there's going to be a second wave? If you do, leave your comment down below. If you don't, also leave it down below. And of course, remember to like this video if you enjoy it and subscribe and hit that bell if you want more daily content about the financial markets. Happy trading, everyone. Bye.